Hey everyone, and welcome to The Explainer. Today we're breaking down a highly structured, totally emotion-free cryptocurrency investment strategy from a channel called TheAbrahamCryptoLand. If you've ever felt the stomach-churning stress of the crypto markets, you're going to find this incredibly fascinating. We're looking at a methodology that literally strips away all the hype, completely ignores the panic, and focuses 100% on discipline and portfolio management.
So be honest with yourself for a second. Have you ever tried to guess the absolute exact bottom of a market drop? Right? It's a universal pain point for all of us. Crypto markets are notorious for these violent swings up and down. And during a correction, it is just so incredibly easy to let fear take over. You watch the numbers drop and you hesitate to buy because you're thinking, oh man, what if it goes even lower? But then on the flip side, when prices skyrocket, people get overly confident. This exhausting emotional roller coaster is exactly what this strategy is built to avoid.
Okay, let's really dive into this. A lot of crypto investors operate with this fatal flaw. They're just waiting around for that elusive, perfect moment to buy. But the reality is, as the creator points out, absolutely nobody consistently knows where the exact bottom will be. It's just a guessing game. Now, contrast that with a prepared approach. Having a rock-solid plan, following strict rules, managing your risk, and above all, staying patient. It's a total paradigm shift from the stressful habit of trying to predict the future, replacing it with a disciplined, pre-planned checklist.
Ultimately, this boils down to one critical choice: emotional decisions versus strategic decisions. We know what emotional decisions look like. Prices fall, fear takes over, you hesitate. Or prices rise, excitement kicks in, and you buy simply because you're terrified of missing out. That's just guessing. Strategic decisions, on the other hand, mean defining your exact buy levels and the precise percentage of capital you're going to use before you even think about entering the investment. It takes predefined levels, serious capital planning, and a whole lot of discipline.
And that brings us to this core mantra from the source material. I believe preparation is more important than prediction. I mean, this is the entire foundation of the strategy. Successful investing isn't about having some magical crystal ball. It's not about predicting every single blip in the market. It is simply about having a clear strategy for whatever happens next. Because when you're truly prepared, the market's unpredictable nature stops being a threat and actually starts being a massive opportunity.
Section 1. Preparation over prediction, mastering accumulation levels.
So, how exactly do we actually prepare? Well, let's start by defining this crucial term so we're all on the same page. Accumulation levels are specific, predefined price areas planned in advance to gradually build an investment position while keeping capital available. These aren't just random numbers pulled out of thin air. They are highly calculated zones where the investor believes adding to their position makes actual strategic sense. So here's the exact step-by-step process of the strategy. Step 1, you wait for your predefined buy levels. You never, ever chase the market. Step 2, when a level is finally hit, you buy according to your plan, using the exact amount of capital you previously decided on. Step 3, manage risk. You do this largely by never buying everything all at once. And Step 4, stay disciplined and repeat the process. The whole goal here is gradual accumulation. You're building a position step by step so you literally always have capital available, no matter what the market throws at you. Seeing this strategy play out is pretty brilliant. As the market drops, you hit buy level 1, then buy level 2, then buy level 3. The rule is simple: no emotions, just discipline. By keeping capital in reserve, this strategy gives you incredible flexibility. Think about it. Cash isn't just sitting there doing nothing. Cash is a powerful tool that gives you options. If a crypto looks great today, but the price totally tanks tomorrow, having that available capital means you can act patiently when the market finally aligns with your targets.
Section 2. The case study. Bitcoin Cash. Executing the accumulation strategy.
To really cement this concept with some hard data, let's dive into a specific case study from our source material executing this exact strategy on Bitcoin Cash, or BCH. Now, what's really interesting here is the specific price range. The creator's current strategy for Bitcoin Cash is based entirely within this window of $200 to $720. Inside this specific zone, they've predefined their levels to use exact percentages of their allocated capital. They believe accumulation makes strategic sense right here, and by drawing a fence around this range, they effectively block out all the noise outside of these numbers.
When you map these predefined levels out against the actual price action, you can visually see how this structured process works. This definitely isn't about guessing where the line goes next. You know exactly where the levels sit in relation to the market. It is a calculated, visual map of preparedness. Let's break down exactly what this means for their capital allocation step by step.
Okay, here's the first specific accumulation level.
At a Bitcoin Cash price of $235, the strategy dictates allocating exactly 20% of their total BCH investment capital. And notice, this specific percentage isn't decided in the heat of the moment while sweating over a red chart. No way. It's decided long before the purchase is ever made. It's completely structural.
Moving down the ladder, if the market gives us a further drop, the strategy is already prepared for it. At a buy level of $200, the allocation actually increases to 25% of the BCH capital. Because they didn't just blow all their cash at $235, they have the resources and the flexibility to act with total confidence at this lower price point. Remember, markets almost never move in a straight line. This tiered approach takes advantage of that volatility instead of falling victim to it.
Section 3. Documenting the journey, transparency, and long-term discipline. You know, a strategy is really only as good as its execution, which is why the creator is so incredibly focused on documenting their real investment journey. They follow a clear cycle: plan, research, execute, review, improve. They explicitly state a goal of showing real, transparent decisions over hype and luck. By deliberately avoiding wild, unrealistic price predictions, they can focus strictly on the process itself. Because if you focus on the process, the results will naturally follow.
To maintain that level of consistency and transparency, these executions are actively recorded. Whenever a Bitcoin Cash accumulation level gets hit, a dedicated video explaining that exact decision goes straight into a playlist on the TheAbrahamCryptoLand channel. It essentially acts as a public ledger of discipline, showing exactly how the strategy is applied in real time, over time, without relying on the luxury of hindsight. So, the absolutely crucial point here comes down to 3 core pillars: discipline, plan, patience. Every single cryptocurrency in this portfolio has a plan, every chunk of capital allocated has a reason, and every single buy level has a defined purpose. Successful investing under this framework completely yanks human emotion right out of the driver's seat. Let's quickly summarize the key takeaways of this explainer. First, always focus on preparation, not prediction. You literally cannot know the future, but you can always plan for it. Second, build your positions gradually, step by step, because like we said, markets don't move in straight lines. Third, always keep cash available. It's a vital tool that guarantees your flexibility in the market. And finally, use these predefined rules to completely eliminate short-term emotional decisions driven by fear and FOMO. This structured method is ultimately how you protect and manage your wealth.
I want to leave you with this final, somewhat provocative thought. Take a hard look at your own portfolio habits. Are your investments currently driven by market emotions, buying when you're super excited and selling when you're scared? Or are you truly prepared with a predefined plan for whatever happens next? Take some time to reflect on that. If you want to eliminate the stress from your investing, definitely consider learning more about structured risk management. Thanks so much for joining me for this explainer, and keep learning.